The stock market offers the allure of getting rich quickly. It sounds easy, effortless, and promising, until you watch your trading account balance slowly decline. Then, reality sets in. You realize you are at the mercy of market manipulators and the companies that issue the shares. Every beginner learns the hard way through trial and error. Losses add up over time and can become surprisingly large due to costly mistakes. Success isn't just about luck, it relies on precise timing, solid strategies, and quick fingers, because every second matters. The stock market can be brutal. It doesn't care about your feelings. You are up against a world where everyone is out for themselves. Although few traders are consistently profitable, those who succeed rely on a deep arsenal of strategies to avoid pitfalls and gain an edge. This can be daunting for beginners due to the steep learning curve and the many obstacles they will encounter. The market is a game of tug-of-war, bears versus bulls, and remember, traders can be bears, bulls, or both. For this reason, price action is highly volatile. It is vital to know the exact time to enter and exit a trade to secure a profit. Otherwise, you'll be left holding the bag. That is why I'm making this video, to share the insights I've gained from my own journey over years of trading. You can take my knowledge, combine it with someone else's, and merge it all with your own to develop a unique trading style. Make sure you record all your trading activities so you can analyze and refine the raw data. That refined data is valuable because only you can figure out what works for your specific style. Keep in mind, this video only summarizes the main points on how to get started, along with tips, tricks, and the precautions you should take. Disclaimer: this is not financial advice. Please conduct your own due diligence, DD, or consult a certified financial expert. This content is for informational and entertainment purposes only. Learn the terminology. Familiarize yourself with these terms, as they are essential and you will encounter them frequently. Keep in mind that order type and time in force may vary depending on the trading platform you use. Choose a trading account. Cash versus margin, day trading. Different platforms have different policies, so it is vital to research which one fits your trading style. A margin account offers more flexibility, allowing you to execute as many trades as you like, provided you meet the minimum balance requirements. In contrast, a cash account is limited by settlement times, which can restrict how many trades you execute per week. A cash account can be a disadvantage if your funds are tied up and you are unable to sell or buy when a stock moves. Violating these policies can result in your account being locked. It is essential to identify your trading style and select the right account from the start to avoid these complications later. Choose a trading platform. There are quite a few trading platforms out there, so choose one that suits your specific trading style. If you are a day trader, you'll need a robust platform that allows you to buy or sell during pre-market and after-hours sessions. You'll need this flexibility just in case an opportunity for a quick profit arises. Keep in mind that the best opportunities often come when you least expect them. By good opportunity, I'm referring to things like meme stocks with huge daily volume and the potential for a short squeeze. Here are some of the most popular trading platforms at the time of making this video. Please explore them to find the one that best suits your needs. 1. Fidelity Investments. Best for overall versatility and retirement planning. Key feature: Fidelity is widely considered the gold standard for all-in-one financial management, offering $0 commission trades, fractional shares, and industry-leading research tools. 2. Charles Schwab. Best for advanced traders and high-net-worth investors. Key feature: after acquiring TD Ameritrade, Schwab integrated the powerful thinkorswim platform, making it a top choice for technical analysis and complex option strategies. 3. Robinhood. Best for beginners and mobile-first users. Key feature: known for its minimalist interface, Robinhood revolutionized commission-free trading. It remains popular for its ease of use and 24/5 market access for select stocks. 4. Interactive Brokers, IBKR. Best for professionals and global investors. Key feature: it provides access to over 150 markets worldwide. While it has a steeper learning curve, its low margin rates and advanced trader workstation make it a favorite for active day traders. 5. eToro. Best for social trading and copy trading. Key feature: eToro allows users to see and automatically copy the trades of successful investors, making it a unique hybrid of a social network and a brokerage. 6. Vanguard. Best for long-term, passive index fund investors. Key feature: Vanguard is investor-owned, which keeps its expense ratios among the lowest in the industry. It is the go-to platform for buy-and-hold strategies and Boglehead-style investing. 7. E-Trade by Morgan Stanley. Best for ease of use and educational resources. Key feature: its Power E-Trade app is highly rated for its balance of professional-grade tools and a user-friendly interface. 8. Webull. Best for intermediate traders who want mobile-heavy technical tools. Key feature: Webull offers more advanced charting and technical indicators than Robinhood while maintaining a similar mobile-first, zero-commission model. 9. SoFi Active Investing. Best for all-in-one banking and investing. Key feature: SoFi integrates its brokerage with its banking and lending services, making it popular for younger investors who want to manage their entire financial life in one app. 10. Moomoo. Best for international stocks and deep data analysis. Key feature: Moomoo has seen a massive surge in users, over 20 million globally, due to its free Level 2 market data and its ability to trade across US, Hong Kong, and Chinese markets seamlessly. Create and organize your watch lists. I strongly advise that you organize your stocks by category. Organize them in the way you find most intuitive to navigate. Here is an example. All index fund stocks go under the index funds header. All big cap stocks go under the big cap stock header. For penny stocks, you might want to have a nested category. For example, you can organize them by sector. Choose your trading method. Day trader, one who buys and sells quickly within a single day. Advantages: quick profits. Entering and exiting a trade can happen within seconds, minutes, or longer. Disadvantages: quick loss. This is also called buying high and selling low. High risk. Executing many trades a day can be risky. It's called overtrading. Wash sale. Please read more on this. It's very important to understand this rule. Swing trader, holding a stock for a few days, weeks, or even months. Advantages: you don't have to constantly monitor the stocks. Make sure you have high conviction in your play. This means you have done your research and believe in the setup. Sometimes, if you are constantly monitoring the screen, you might panic and click the sell button when you aren't supposed to. Price fluctuations can easily force you into making a bad decision. Wash sale. There is less risk because you don't buy and sell the same stock as often. Disadvantages: you might miss the opportunity to sell when the stock hits your target price because you are not constantly monitoring it. Long-term investor, holding stocks for months or even years. Advantages: there are tax benefits for holding stocks for over a year. Please do your own research to learn more. Disadvantages: you might miss the opportunity to sell when the stock hits your target price because you are not constantly monitoring it. Join a trading community to monitor market sentiment and see what other traders are discussing. Here are some popular chat communities at the time of making this video. 1. StockTwits. The Vibe, real-time social media for traders. Best for gauging market sentiment on specific tickers. Overview. Often called the Twitter for stocks, StockTwits allows you to follow specific symbols to see a live stream of what other traders are saying. It uses bullish and bearish tags to provide a quick visual of the overall mood for any given asset. 2. Reddit, Wall Street Bets. The Vibe, high energy, high risk, and often irreverent. Best for monitoring high volatility setups and squeeze candidates. Overview. This community is famous for its massive influence on meme stocks and highly volatile trades. While the culture is chaotic, it is the primary hub for tracking retail momentum and significant short interest plays. 3. Reddit, Investing. The Vibe, educational, measured, and fundamental. Best for long-term strategy and broader market discussion. Overview. As a wild card to the high volatility world, this subreddit focuses more on fundamental analysis, economic trends, and portfolio management. It is a great place to ask questions about market mechanics or long-term investment theories. 4. Seeking Alpha. The Vibe, professional research and crowdsourced analysis. Best 4. Deep dive articles and peer-reviewed investment theses. Overview. While it features professional writers, the comment sections are where a lot of the community engagement happens. It is particularly strong for those who want to read detailed arguments for or against a specific stock's valuation or sector performance. 5. TradingView Community. The vibe, technical and chart-heavy. Best 4. Learning technical analysis and sharing chart setups. Overview. TradingView isn't just a charting tool, it has a massive social layer where users publish ideas. You can see exactly how other traders are drawing their support and resistance lines or what indicators they are using to predict price movements. Before you trade, pick a stock and do your own research. Never listen to anyone, especially in the chat rooms. Always remember, no one cares about your feelings, whether you win or lose. The market is brutal. Imagine money is flying everywhere, and everyone is trying to grab it. Here are the things I look for when picking a stock to trade to lower my risk. Balance sheets. Companies with terrible balance sheets are very likely to dilute their shares or conduct offerings. This happens more often than you think. Please do your own research on how offerings and dilution can impact a stock's price. Insider ownership. When insiders hold significant shares in their own company, it usually signals confidence in the business. However, do not solely rely on this metric. Institutional ownership. When institutions hold a large percentage of shares, it suggests they have confidence in the company's stability. However, do not rely on this metric alone. Short interest. The total number of shares of a specific stock that have been sold short by investors but have not yet been closed out or covered. The higher the short interest, the more likely a stock is to trigger a squeeze. Cost to borrow. Cost to borrow is the annualized interest rate a trader must pay to a brokerage for the privilege of borrowing shares to sell them short. The higher the cost to borrow, the more likely a stock is to trigger a squeeze. Volume is the amount of shares exchanged. There are two things about volume you need to pay attention to. 1. High volume indicates high trader activity. This means the price could move significantly, either up or down. 2. Low volume indicates there aren't many traders buying or selling. This can be either good or bad. Buying into a low-volume stock can tie up your capital, effectively turning it into dead money. In this situation, it is difficult to exit the trade until volume returns to trigger price action, unless you are willing to sell at the current market price to get out. Analyze charts across different time frames, such as the 1-minute, 5-minute, 10-day, 180-day, or 1-year views. Set them up to suit your specific needs. Charts help you predict a stock's direction. By analyzing various types of charts, you can make a more educated guess. Since charts move in patterns, this is often what sets traders and their styles apart. Some traders excel at reading these patterns to anticipate market movement. This is where your wisdom comes into play, by combining historical chart data with current market momentum to help predict the future. Trading strategies. Analyze your trading activities to identify what works best for you, as what works for me may not work for you. Here are some useful tips to consider when trading. 1. Join a chat community to see what other traders are buying or recommending. This is the fastest way to know which stocks are most active. Again, never listen to anyone. Always do your own research. It's your money and your decisions. 2. Monitor global news, such as pandemics or geopolitical conflicts, so you can enter positions before the rest of the market reacts. The core principle is to buy low and sell high. Keep in mind that penny stocks often experience massive runs, but they come with increased volatility. 3. Pay attention to huge daily volume stocks. These stocks are very likely to run spanning multiple days. 4. When the market crashes, large cap stocks almost always recover. Determine the best entry point and hold your position long-term. If you can identify a strong entry, you can often double your money once the market rebounds. 5. Analyze charts and figure out patterns that work for you. Charts usually give you indications of the current and future price movement. There are many factors involved in price movements such as good news, bad news, manipulations, future events. Sometimes, it's a trap. The moment you buy in, the price collapses. Do research to help you make better decisions. 6. Penny stocks are very volatile and very high risk due to limited funds. Big risk and big rewards. Stocks can run 1000% every now and then. 7. Buy at support level whenever you can. 8. Know when to double down or execute a stop loss. Doubling down involves averaging your entry price, either up or down. A stop loss is an exit strategy where you sell your position to prevent further losses. Averaging up or down requires rapid decision-making. If a stock drops significantly due to bad news, you must decide, are you willing to hold and average down, or should you simply take the loss? Be careful. Averaging down on a failing stock can double your losses if the price fails to recover. Always use your best judgment. Know your stocks thoroughly so you can decide whether to average in or cut your losses before it's too late. 9. Stock A at 10 cents per share versus Stock B at $1 per share. If you own 10,000 shares of Stock A and 1,000 shares of Stock B, and both run 100%, your total gains are identical. Beginners often fall for the illusion that owning a higher quantity of shares is inherently better. However, cheap stocks like Stock A often move much slower, especially if the float or outstanding shares are massive. These penny stocks typically have high share counts due to dilution or frequent offerings. Additionally, some platforms charge commission fees based on the number of shares traded. The more shares you own, the higher the fees, which can quickly erode your profits if you trade frequently. There are at least 5 ways you can blow up your account. 1. Lack of information. Many traders fail because they don't read financial statements or company Securities and Exchange Commission (SEC) filings. When companies go bankrupt, losses can be significant. 2. Offerings or dilution. You can usually expect to lose 30% to 50% of your total position value in that particular stock. 3. Reverse split. This occurs when a company reduces its total number of outstanding shares. This usually happens because the share count has become too large or because the company needs to increase its stock price to meet exchange listing requirements. For example, if you own 30,000 shares and they announce reverse split 100:1, you will end up with 300 shares. 4. Market manipulations and emotional traps. One minute you feel like you're on top of the world, the next, you're at the bottom. For example, a stock you bought goes up $1 and you feel invincible. But as soon as you look away and look back, it has dropped $2. It is the worst feeling ever. At this point, you regret for not selling when it went up $1. As panic sets in and it looks like the price will fall further, you hit the sell button to take a loss. Then, the moment you sell, the stock rockets up, $3, $4, $5, and more. Now, you are assuming it will keep climbing. You want your money back and buy back in. Guess what? As soon as you buy back, it crashes again, and you panic sell a second time. This is called revenge trading. Be extremely careful with back-and-forth trades where deceptive price movements cloud your judgment. Also, when you sell for a loss, buy back and then sell for a profit right away. You've just violated the wash sale rule. You must read and understand wash sale rule. 5. Put everything in one basket or all in. This is for risk takers. Sum up. Don't put all your money into one basket unless you are completely confident in the trade. There are once-in-a-lifetime opportunities to go all in and double or triple your money. Sometimes a stock can run 300% or more. Again, analyze the chart to identify this specific pattern. It's very rare, but it does happen. Many stocks ran 100% or more during the pandemic, wars, or market crashes. Choose a trading platform that is fast and user-friendly. Be the expert at using it. Stocks can turn their backs on you at any time. Remember, they are not your friends. Analyze different types of charts. Record all your trading activities. Pay close attention to stocks that have a history of running big. They tend to do so again. Be mindful of geopolitical events. For example, during wartime, oil stocks tended to run. Buy at the support level, where the price is less likely to drop further. Please do your own research on how to identify and trade support and resistance levels. Avoid buying at the resistance level, as the price is likely to fall back down to the support level. Please do your own research on how support and resistance levels affect price action. Avoid revenge trading or overtrading. When you execute multiple trades in a day and lose them all, it's not your day. Don't force it. Always take profits. Small profits add up. Always buy low and sell high. Enter a trade early and exit before the sell-off. This is where greed comes in. Many times, stocks go up so much that you think they will go even higher. Then, all of a sudden, you see a massive drop. Feeling regret, you blame yourself for being greedy. It happens to many traders, especially beginners. Know your tolerance level. Be careful when buying stocks that have already run up, because what goes up must eventually come down. Avoid wash sale rules. Ensure your trading setup is simple so you can navigate it with ease. Traders with quick fingers have a significant advantage. Since it only takes a second or two to execute a trade, being slow can cause you to miss a massive opportunity. In the stock market, everything happens within seconds, so always be prepared. Avoid offerings or dilutions. It occurs often, especially with penny stocks. You can lose 30% or more when it happens. Read company balance sheets and read Securities Exchange Commission (SEC) filings. Avoid reverse splits. They usually happen when the outstanding shares are massive and the price is low, or when a company needs to meet listing requirements. I'll stop here to let that sink in. I hope you found the information in this video useful. Remember, this is just a glimpse into the vast world of trading. There is so much more to explore. Please subscribe, like, and turn on notifications so you won't miss my next video. Also, don't forget to leave your comments below.